Obviously, the Telstra result was out yesterday. The stock was sold off quite heavily on the back of that result. Technically, it was in line with their EBITDA guidance, as was the outlook, but at the EPS or NPAT level, it did miss by around 5%. It really missed due to higher depreciation and amortization charges, which don't particularly bother us. But I guess the bit that was a little concerning was the NBN payments, which I'll talk about in a minute, just being slower than expected. And that has resulted in us cutting our EPS and holding the dividend flat for the next few years. So the depreciation and amortization rates have accelerated. I think that's quite sensible given the changing landscape, both with the NBN and the technology environment we're in. That doesn't bother us. I guess the bit that's the challenge is the national broadband network. The recurring payments from that were a bit lower than we had expected. If you look at the NBN rollout, the number of houses connected has more than doubled in the last 12 months. So you'd think that naturally that would flow through to Telstra's recurring payments doubling because it should be following that, but they're actually only up about 20%. And a lot of this is timing. It doesn't mean that they're not going to get paid. It just means they get paid more slowly than I guess we had originally anticipated. So when you put that slower cash coming through from the NBN and you combine it with the higher capex that they flagged about 6 months ago, it means their balance sheet starts to move over the next couple of years from being at the bottom end of its gearing range towards the higher end. And I think that just means, given the amount of stuff happening in the world that they operate, they're not as likely to be increasing that dividend. They're more likely to retain their capital for buybacks and obviously to invest in the core business to offset those NBN challenges. So unfortunately, that's meant we have cut our dividend from growth to flat for the next couple of years. In terms of our investment view, we've kept a hold on the stock. We think those that are looking for a dividend, it still looks okay. The dividend's still pretty solid. Unfortunately, not as attractive given it's not growing. For those that are looking for growth, we've said for a while it's going to be very hard in this sector, not just for Telstra, but for TPG and Vocus as well. Very, very competitive. So we think there's better options elsewhere. Our two key picks are Speedcast, which is in our high conviction picks. That reports on Tuesday the 28th, and NextDC, which reports next Friday the 24th.